Hello everybody, I'm Jeremy Tumkulu, aka grad CGPA MCOM BSc. I welcome you all to this second week's presentation in our corporate finance lecture series. And our target area this week is risk and return. I hope you're going to enjoy the video as you did in our previous week's lecture. Now, this week's learning objectives are just 6. Okay, they're just 6 learning objectives where by the end of the presentation, students should be able to differentiate between risk and return, measure the risk and return of a single asset, measure the risk and return of a portfolio, distinguish between market risk and unique risk, discuss the relationship between risk and return as per capital asset pricing model. So which means these are the main areas we are going to focus our attention on throughout the presentation. Now, risk and return. The term risk is used interchangeably with uncertainty to refer to the variability of returns associated with a given asset. Risk is the potential departure of actual outcomes from expected outcomes. So we can see here that when we talk of risk, we are simply saying that this is the potential or possibility of us failing to achieve what we intended to achieve. Okay? Potential, possibility, or probability. Okay. So, to assess risk on the basis of variability of return, there is need to know what return is and how to measure it. The leading academic book is the Gitman Financial Management Series, where most of these concepts are well elaborated. Okay, so risk is reward. Return, on the other hand, is the reward for the commitment of resources in an investment. So most of business people believe that the higher the risk, the higher the return. That one has been also proven empirically because most of successful entities the world over have been maneuvering the terrain of high risk. Okay, so if you want to make more money, it is actually advisable that you should also be willing to engage in more risk. However, the risk should be manageable. Okay, it should be manageable, and by the end of this lecture, you would know that risk can be managed. Okay, risk can be managed. There are certain measures which should be employed to ensure or to assess the level of risk, and also the issues to do with diversification, where you can't actually put all your eggs in one basket, but you need to at least ensure that you spread out your investment to ensure that the risk is minimized, the risk exposure is contained. Okay, so we are saying that return and risk are actually partners. Okay, are actually partners. You take higher risk because you expect a higher return. Sometimes if you take low risk, okay, the returns might be also high, but it is actually not always the case because of certain market forces. Because, for example, in an industry where there is low risk, there is also a danger of higher competition. The competition will be high. because everyone would want to invest in something that is of low risk. So by the end of the day, the competitiveness of that particular industry will be subdued. So this is why by the end of the day, it is a game of high risk, high return. Measures of risk to be considered are variance, standard deviation, covariance, and the beta. Okay, the total return is the total gain or loss experienced on an investment over a given period. Mathematically, an investment's total return is the sum of any cash flows, any cash distributions, for example, dividends or interest payments, plus the change in the investment's value divided by the beginning of period value. So you see this formula as we go with the presentation. Now, risk and return fundamentals. To maximize return, finance managers should assess risk and returns. For convenience, publicly traded corporations are used. Publicly traded corporations are used, but the concept also applies to other business sectors. Concept centers only on wealth of ordinary shareholders because they are the residual owners whose returns are in no way specified in advance. Each financial decision has certain risks and returns. The unique combination of these has an impact on share movement. So you can see that most of the theories around the risk and return are usually having the equity shareholder in mind. Why? Because these guys are the most vulnerable investors. They're the most vulnerable investors. If you know, if you remember about the pecking order theory, where we say that an entity should at least vie for at least lesser risk finance. So it must vary from lesser risk finance to higher risk. So, for example, it is better to invest using retained earnings. From retained earnings, we can move to debt finance, and then preference share capital, and lastly to equity. Okay, we do this because retained earnings are more cheaper. Okay, they are more cheaper because they are internally generated funds which we have much control over. But the moment we go out to get debt, of course, debt is cheaper in the sense that it is tax deductible. But you will see that the moment this debt gets out of hand, our interest repayment power, okay, because by the end of the day, debt is a cost in terms of interest payments. So our interest payment power or interest paying power would be subdued if the debt gets out of hand. Okay, suppose we borrowed money hoping that what we wanted to do was going to expose us to high inflows of cash, but only to discover that after a certain period of time, our cash flows were almost non-event. They were not coming. So we might end up failing to pay. or to repay or to service the loan. So the pecking order theory stipulates that investors would prefer a rather a less riskier source of finance to invest in, rather than to just pick whatever that comes along their way. So most of the theories which are linked to the risk and return, they are worried much about these residual earners, the equity shareholders, because they are the most risk investors, the highly risk exposed investors. All right, I think they have been well understood. So each financial decision has certain risk and return. So no matter how unique or how smart a decision might be in finance, by the end of the day, there are risks attached to that particular decision. Like I have emphasized in my previous example that even if an investment might seem to be of low risk, the implication might be that it is going to invite more competition. So by the end of the day, if you want to venture, for example, in the business of selling vegetables, by the end of the day, you discover that there is low barrier. There are low barriers to entry. So everyone, every Jig and Jill can just get into that market, and by the end of the day, the market will be flooded and the returns will be so low. So the lower the risk, the lower the return. Now, investors have got differing preferences. Okay, remember, risk is a chance of a financial loss or the variability of returns associated with a given asset. The more nearly certain the return from an asset, the less variability of its returns, and therefore the less risk. Risk preferences. Feelings about risk differ among managers and firms. Okay. Although the agent theory suggests that in practice, managers may not behave in a manner consistent with the firm's risk preferences, it is assumed here that they do. Therefore, the risk preference of a manager and a firm are assumed to be identical. Thus, it is important to specify generally accepted level of risk. Okay, the generally accepted level of risk. Now, when you are talking of risk preference, we are simply saying that as an investor, we have different beliefs, okay, or appetite towards the risk. Okay, some might be willing to take the risk. Others might be having a second thought about taking a particular action. Okay, so risk preferences is all about what a manager or an investor feels about a particular situation or particular decision. You will see in the next slide. Okay, you can see here that we are having about 3 different managers. Okay, there is manager number 1, who is risk indifferent. This guy is risk indifferent. This is the attitude where no change in return is required for an increase in risk. So even if he increased investing in a particular investment, he is not actually having the issue of return in mind. Okay, or he is not actually concerned whether the return is going to increase or not increasing. Okay. For instance, in different manager, the required return does not change as risk goes from a multiple of 1 to a multiple of 2. Okay, no change in return is required for the increase in risk. But this is actually awkward. Okay, this is awkward. Let us just be real. This is awkward because by the end of the day, whose funds are you going to use for that? Because by the end of the day, you have to be a steward. If you're a manager, you have to be a steward. You have to report to certain people, for example, financiers or shareholders. You just have to report back to them. So you can't just say I wasn't actually worried. Okay, I wasn't worried about the return. What I wanted to do was just to ensure that the job was done. No, it doesn't work like that because there is a cost of capital. We need to pay back to the people who have given us that money. Then we've got a risk-averse manager. This guy fears risk. This guy fears risk. An increase in return is required for an increase in risk. Yeah. Managers shy away from risk and require higher returns should they end up in risk. They feel that more risk is more money. Okay? Or it is better for us not to venture into a particular course of action. Otherwise, if we venture into that particular course of action, we need more money. So they don't just enter into a risk. They don't actually like entering into those ones because they know or they feel that if they are made to get into that particular action, they have to be paid more. They have to get more out of whatever effort they put in a particular investment. So in general, these guys, they do not want to take any risk. They shy away from risk. Okay? Then we've got guys who tolerate risk. They tolerate. They seek risk, actually. They seek risk. Okay? So they are risk tolerant. A decrease in return would be accepted for an increase in risk. So these guys, they say that we can't grow if we do not take risks. So they have got a tolerance of low return when they take more risk. Okay, this is actually synonymous with companies in high-tech companies. Okay, for example, these Apples, the Microsoft, Microsoft, or even the Amazon. Okay, they believe that you need to try things. Okay, so by the end of the day, not everything you try is going to bring something, but you just have an attitude of tolerance. You have to tolerate low return, but you mustn't stop trying. That's the belief of a risk taker. Okay, so these concepts are usually confused: the risk averse and the risk seeking. People think that a risk averse investor he doesn't want to take risk, therefore he expects low return. No, the reason why he doesn't want to take risk is because he believes that a higher risk should be compensated with higher return. Okay, so or else I don't want to take the risk at all. So should I take the risk, therefore the return should be high. The difference now is that those guys who tolerate risk, they have an attitude of acceptance that if the returns are low, it is well. Okay, it is well with us. Now, theoretically, because they enjoy risk, these managers are willing to give up some return to take more risk. However, such behavior would not likely to benefit the firm. So, by the end of the day, such behavior is not likely to benefit the firm. Here, we are simply saying that not all those returns are going to benefit, but it is through trial that has seen most of these companies outwitting or outpacing their competition. Remember that most shareholders are also risk averse, like risk averse managers. For a given increase in risk, they also require an increase in return on their investments in that firm. Most managers are risk averse. For a given increase in risk, they require an increased return. They generally tend to be conservative rather than aggressive when accepting risk for their firm. Okay. So the main position in risk and return is centered on the risk averse investor. This is where the concept of risk and return is centered usually on the risk averse investor, the most cautious investor, okay, who believes that the higher the risk, the higher the return. And this is the main concept which is going to guide us throughout this particular lecture. Now, we are going to look at the risk of a single asset. Usually, sensitivity analysis and probability distributions are used to assess the general level of risk embodied in a given asset. Sensitivity analysis is an approach for assessing risk that uses several possible return estimates to obtain a sense of the variability among outcomes. When we are talking of sensitivity analysis, we are asking ourselves, what if something happens? Are we going to remain with the same value? Okay, what if the selling price of a commodity reduces? Are we going to earn the same gross profit? What about if customers tend to a competitor and shun away our product? Are we still going to be in business in the next 2 years? That's sensitivity analysis. One common method involves making pessimistic or worst most likely expected and optimistic best estimates of returns associated with the asset. In this case, the risk is measured by range of returns. Range is found by subtracting the pessimistic, the worst one, the worst variable or worst amount from the optimistic best outcome. Okay, you may refer to Gitman. I talked about this in my introductory part. Probability distribution. These provide a more quantitative insight into an asset's risk. The probability of a given outcome is its chance of occurring. Probability distribution is a model that relates probabilities to the associated outcomes. If one knows all possible outcomes and associated probabilities, one could develop a continuous probability distribution graph. And we'll touch some of these probability issues when we do the expected returns. Now, the total return is the total gain or loss experienced on an investment over a given period of time. It is calculated by dividing the asset's cash distribution during the period plus change in value by its beginning of period investment. So we are talking of this formula. Okay. All right. There is this formula. We are saying that KT, okay, is equal to CT plus PT minus PT minus 1. Okay, usually just put brackets, okay, all over PT minus 1. And they're saying that this CT, okay, is the cash flow. KT is the return, okay, this is the return. This is the return or total return on an investment. Then CT is the cash flow received from the asset investment in the time period. For example, the cash flow received could be a dividend. This could be a dividend, EBITDA, okay, plus the value, the PT, the price of the asset which was invested. For example, the share price. This might be the share price, the SP, the share price, okay, the share price at the end of the period minus the share price at the beginning, or over the share price at the beginning. So at the beginning, we might actually say T minus 1, okay, or 0, SPU 0, and this is SP1. 1 is in, usually when we are talking of dividends, it's in the next period, but in this case, we are talking of 1 is in the current, okay, or the end from 0 to 1. 0 was the beginning and 1 of the end, okay, so over SP0 here, the share price at the start. All right, I think we can illustrate this with an example. Okay, we're having this particular example here where we may calculate the return of an asset, and we still use the same, this is the same formula, okay, as I've highlighted before. All right, the price of the stock at the beginning of the year was 60. The dividend paid from this stock was $2.40. So like I said, C is, so our R is going to be C plus this and that. So the C is the dividend. So 240, okay, 240 plus the share price. The share price at the end was 69. Okay, this is the way I put a 1. Okay, if you still remember the formula, and where I said SP0, that's the beginning of the period, that is 60. Okay, all over 60. All right, so you can see that your return is going to be that's 69 minus 60. Okay, that's 9 plus 240 plus 240 over 60. That's 0.19. That's the return of the stock, 0.19. Okay, this might also be broken down into, you may simply say the 240 could be having the denominator here of 60 plus the 69 minus 60 over 60, again the same denominator. This is simple mathematics we did at O level. Okay, they are sharing the same denominator, but the reason for the demarcation is to highlight that this one is the current return, the current dividend, current return, and the capital in the sense that this is an appreciation of the share price. share price appreciation, so that's capital return. Okay. Now, average returns, average annual return. This is an arithmetic formula, okay, where we are saying if you are given returns of, let's say, 5, the information about the return of a particular stock over a certain period of time, let's say for over 5 years, let's say the return was 10% in year one, the return was 10%, year 2, 11%, year 3, 9%, year 4, 13%. Now, the arithmetic mean simply says that you just have to add these returns and divide by 4. This is why they are saying summation of return over n. N is the number of periods. All right. Let us go to an example there. These are the returns. As you can see, these are the returns, the information, and the arithmetic mean would be, these are how many? 1, 2, 3, 4, 5. So 5 years. So this is why you are seeing the returns on top divided by the n of 5. So we get 9.6. Now, the geometric mean is a bit advanced in the sense that it takes into consideration the time value, the effect of compounding, the compounding effect. We did this in our previous lecture, okay? We talked about the geometric mean, and you mustn't be dazzled at this point now. You should stay into your ground, okay? And this is the formula for the geometric mean. Okay? And consider the total return and revenue. Total return and return relative, that is 1 plus RI for stock A over a 5-year period. So you are given this information over a 5-year period. Relative return, that is I plus R1. 1 plus RI. Okay, this is the return. Okay, and the relative return is 1 plus RI, and this is our RI. Remember, in the formula, it is actually clear. Okay, geometric mean is given by 1 plus RI, 1 plus R2, 1 plus this, 1 plus that. Okay, that's how you compute your geometric mean. So you just do the same here, and you are going to obtain the geometric mean here as given. All right. So this can also be presented. This 1 over 5 to the power 1 over 5 can also, to the power 1 over 5 can also be presented as a root, fifth root, and then you do your bracket 1.19, 1.14. Okay, just the same. This simply means to the power fifth root. Okay, this simply means to the fifth root. Okay, and then when you finish doing that, you can just put in the figures in the big bracket, and then you have to deduct 1. All right, I'm sure you're done there. Okay, you just have to practice with your calculator, and these figures are not actually a challenge. Okay, this is not a challenge at all. Okay, now let's talk of the expected return and risk of a single asset. We have talked about the arithmetic return and the arithmetic average as well as the geometric average. Let us now move to the expected return and risk of a single asset. When you define the probability distribution of the rate of return, remember that the possible outcomes must be mutually exclusive and collectively exhaustive. The probability assigned to an outcome may vary between 0 and 1. The sum of the probability assigned to various possible outcomes is 1. So we are saying that probabilities are values between 0 and 1. Okay, or 0 and 100%. All right, so which means a probability could be 0.1, 0.99, but it is not going to exceed 1. Neither is it going to be below 0. We do not have a negative probability. So they are between 0 and 1. 0 and 1. Okay, based on the probability distribution of the rate of return, you can compute the expected rate of return and the standard deviation of rate of return. So let us just illustrate this with an example. All right, we are given the rate of return of national food stocks and Pacific shipping stocks. So there are two stocks here. We are given the national foods here, and the Pacific stocks. These are the rates of return. So we are also given the economic status. Okay, during the boom, there was a 30% chance that their returns were 16 and 40 respectively. Then during the normal periods or normal state of the economy, then there was 50% chance that the returns would be 11 and 10. Then during recession, there was 20% chance that the return would be 6 and negative 20. Okay, negative 20. So you can see the return might be negative while the probabilities are not going to be negative. Okay, they will be within their positive. Either it could be 0 or 1. Okay, between 0 and 1. So the expected rate of return is the weighted average of all the possible returns multiplied by their respective probabilities. So this is why we are seeing summation PI. The PI is the probability. So where ER is the expected return, RI is the return for the ith possible outcome, while PI is the probability associated with RI, and N is the number of possible outcomes. The expected rate of return on national food stock is ERNF. So this gives us, okay, let us just go to the figures so that we understand them as they are. Okay, expected return. Okay, we can just say ER for let's say national foods. Let me just say national foods. Here are national foods. It's going to be, all right, we are going to just consider the whole state of the economy using the national foods information. So we're going to say the return was, or the probability, the first probability for the boom, that's 0.3 multiplied by the relevant return, which was 16. We close bracket. We then have to add the other state of the economy, 50%, okay, multiplied by the respective return of 11 plus 20% multiplied by 6, and we get the return there. All right, get the return of how much using our calculators, 0.3 multiplied by 16 plus 0.5 multiplied by 11 plus 0.2 multiplied by 6, and we get 11.5 as the expected return. This is the 11.5 we are talking about. So we do the same for the this Pacific stock, and we obtain the 13% here. Okay, so just have to replay. Okay, just replay, take your time to see what, because for the Pacific we just do the same expected return Pacific, expected return Pacific, we get that's 0.3. You just use the same probabilities, 0.3 multiplied by the respective return, okay, plus 0.5 multiplied by 10 plus using the same, and you should get the solution of 13%. Now, the standard deviation. Risk refers to the dispersion of the variable, of a variable. Dispersion of a variable. Remember, I'm sure you still remember the issue of the normal distribution. And this is the mean, okay? When you talk of dispersion, we are just talking of the distance from the mean, from the average. Okay, so the idea of standard deviation, we are talking of deviation from the mean. From this is the mean. This is the mean. Usually the X bar. Okay, that's the mean. All right, so when we talk of deviation, we are deviating from the mean. Okay, we are not doing that at the moment. Let us just move. It is commonly measured by the variance or the standard deviation. So the variance is this sigma squared. So standard deviation is just sigma, as you can see there. So this is the formula for the variance. So you first, if the question says determine the standard deviation, it means that you just have to first calculate the variance before you go to the standard deviation, because the standard deviation is the square root of the variance. Is the square root of this. Okay. Now the coefficient of variation. This measures the relative dispersion that is useful in comparing the risk of the asset with different expected returns. So when we calculate assets with different expected returns, we will be forced to determine their the covariation. So the coefficient of variation is measured with the formula CV is equal to sigma over expected return, KE. Okay, illustration on the calculation of standard deviation. Okay, using the same information for national foods, you can see that this is the state of the economy, and then the probabilities, the returns of the stocks in each state of the economy, and then the probability, which is PI multiplied by RI, get this one, and then RI minus expected return. Okay, RI, this is RI minus expected return. You get 4.5. Okay, and I'm sure you're still aware that our ER for national foods was 11.5. I'm sure if you still remember here, let me just take you back a bit. This is the ER we are talking about, the 11.5. Okay, please don't be confused. Okay, so here we are told that RI minus ER, RI is 16, so 16 minus ER 11.5, we get 4.5, and this is the 4.5 we are talking about. Then we have to square this. We have to square this. This is why RI minus ER now is in bracket squared. So if we say 4.5 squared, we get this value. And then we have to multiply this value now. We then have to subject it to the probability. So multiply by 30%, how much do we get? 20.25 multiplied by 30%, we get 6.075, and this is why we are getting this. Okay, you do the same, you get this, and then you get the summation. Okay, the summation, this is the variance, this is the VAR, because our formula here indicates that the formula should be this one, summation of PI minus AR squared. That's the variance formula for variance. Okay, and then you have to subject this or to calculate the root of this figure to get the standard deviation. All right, I noticed something here, please just 1 minute. A typo. Okay, there is a typo here. This formula should read summation of PI RI minus ER. Okay, minus ER. Okay, squared. That's the formula. That's how the formula should read. Okay, because we are not deducting the probability per se from, I mean, the expected return from the probability, but we are deducting the expected return from a return. Okay, the average return from a return at a particular state of the economy. Okay, then we add those, then we square those ones and then subject them to the probability of a particular economy. And then we then add up all those economies' probabilities, and then we get the variance. I'm sorry to take you back, but that would assist our learning. So this one again is the computation of the standard deviation. Let us just move on. These are the formulas you may be accustomed to for you to revise. Okay, you can see that in the event of a single asset, the expected return is just the arithmetic mean, as you can see here, right? And when we are using the probabilities, it becomes this one. That's the formula. The variance, this is the formula of the variance. Remember, here they just put the xi's. Okay, they just put the xi's, but these might also be errors. Don't be confused. They might also be errors. Okay. And then if we are not using probabilities, you will see that the variance formula will be having an n. But when we are using probabilities, the n disappears, and we are using the probabilities, and the p's come into play. Then standard deviation is the square root of the above formula. Square root of the above formula. That's standard deviation is the square root of the variance. And then covariance, these are the formulas for the covariance. Please try to get used to them. Okay, now we are now going to a portfolio of assets. It's now more than one asset now. Okay. Risk and return of a portfolio. A portfolio is a planned spread of investment that is combination of one's investment. Investors invest in different shares or assets to reduce risk, that is, avoid total loss. This is the issue of diversification. Okay. Losses in one company or share or asset may be offset by gains in another company. So we are talking of diversification. Okay. Portfolio returns. Portfolio returns represent an average of the returns of the individual assets in the portfolio. Expected return depends on returns from the individual assets forming the portfolio, will also depend on the proportion of funds invested in each asset. If you invest in a poor share or asset or company, returns will be lower than in good shares. So the expected return of a portfolio is given by the formula W1 expected return plus 1 minus W1 expected return 2. Okay, where expected return is the expected, where ERP is the expected return on a portfolio, WI is the proportion of the portfolio invested in security 1. ER1 is the expected return on a security 1. Then 1 minus WI is the proportion of the portfolio invested in security 2. Okay, you see the reason why they put remember the proportions, when you are talking of proportions, they are also like probabilities. They are between 0 and 1 or 0 and 100%. Okay, so if there are two assets to be considered in a particular portfolio, then if we have given asset A a proportion of, say, W, obviously the remaining asset would be 1 minus W, because they do not exceed 1 in their value. This is why they put 1 minus W1. Are we together? Because they are between 0 and 1. Obviously, if another portion is W, then the other portion is 1 minus W. Consider a portfolio consisting of two securities and B. The expected return on these two securities are 10% and 18% respectively. The expected return on the portfolio with the proportion invested in A and B are 0.4 and 0.6 is simply, we are saying when the proportions are 0.4 and 0.6 respectively, simply mean that if you add 0.4 and 0.6, they get to 1. So it's like the law of probability. So you can see that you can now see that 0.4 multiplied by the return plus 0.6 multiplied by the return for B, and you get 14.8%. This is the expected return for the portfolio. In general, when a portfolio consists of N securities, the expected return on the portfolio is ERP, which is equal to summation of WI expected return. So the substitution WI, I simply mean that the return, okay, a particular return, they might be 3 or 4 returns, okay. The I is the proportion, the WI is the proportion of a portfolio invested in securities, let's say security 1 or security 2, security 3, and so forth. So the I is not actually discrete. It might be continuous, but up to a certain amount. Because by the end of the day, these portfolios, they are unknown numbers. You can't just say I've got an infinite portfolio. It doesn't work like that. It is a portfolio which is known. The assets are actually known. Okay. It can't be a portfolio when the assets can't be known. Okay, because there is some limitation in the way individuals invest. Okay, you can't just invest into infinite. No, your portfolios are known. Okay. So let us consider a portfolio consisting of 5 securities with the following expected returns. We've got expected return 10%, return number 2 12%, expected return 3 15%, 18%, and 20%. The proportions invested in these securities are weight number 1 0.1, number 2 0.2, W3 0.3, W4 0.2, and 0.2 again. The expected return for this portfolio is ERP, then weight multiplied by return plus weight multiplied by return. One thing you have to only guard against is an error for misplacing the returns and their weights. A weight should tally with or should marry its respective return. That's one thing you just have to be aware of or to be careful about. Okay, make sure, for example, weight W1 should marry return, expected return 1. Okay, so 0.1 should marry a return of 10%. 0.2 weight 0.2 should marry 12%, and so forth, and you get your answer, the expected return. Okay, we talked about the diversification, where we are saying that you can't put all your eggs in one basket and so forth. So let us move on. And the issue of expected returns, do we need the explanation there? We talked about this. It's just the same. Okay, this is just the same. And all right, somebody might say, hey man, it's not the same, we need a replay. Okay, this is the same tabulation, ladies and gentlemen. Okay, this is the state of the economy. Sometimes they give you just figures. It's the state of the economy 1, the probability was this, and the return on the stock was this for stock A, and this is stock B, and then the return on proportion. Okay, the proportion. Let me just verify here. Okay. From my own view, this is just the same information we have just computed. The only difference is that we are now having two stocks plus a portfolio where these same stocks have been grouped in their, in equal proportions, but the computations are just the same. Just have to calculate as usual the expected return, the standard deviation of each stock and of the portfolio, and just have to come with the same conclusion, as you can see in the next slide. Okay, this is the expected return. Okay, that's ER. This is the ER. Okay, sorry, ER. We just write our ER, or ERP. All right, this is the ERP, the expected return of stock B, and the expected return of the portfolio. But you can see that it's still the same method where we say this is the P and this is the return, the RI, P multiplied by RI. Okay, but don't forget to marry, okay, the probability with its respective return, probability with its respective return, and so forth until you finish. All right, then the standard deviation, you first have to calculate the variance, and variance, we say that variance is summation of P RI minus expected return. Right. And this is what is happening here. This is RI and this is expected return. Okay, in bracket there, and this one is a P, 0.2 is a P. Okay, and then you have to square. This is the same, that is the same thing that is happening here. You do the same. This is now the standard deviation, which is a root of the variance, and the variance is 200 here. It is being rooted here. Okay, that's the square root of the variance, and you get your 14.4%. You do the same, you do the same. That's how you do it. Now, the measures of market risk. The market risk of a security reflects its sensitivity to market movements. The sensitivity of a security to market movements is called the beta. Okay, it's called the beta. A security which has a beta of, say, 1.5 experiences greater fluctuations than the market portfolio. On the other hand, a security which has a beta of, say, 0.8 fluctuates lesser than the market portfolio. Individual security betas generally fall in the range of 0.3 to 2 and rarely, if ever, assume a negative value. The following market model is employed to calculate the beta, where we have RGT is equal to AJ plus BRJ RMT plus the constant EJ, right? And the formula there, just have to play around with it. No need to worry about its derivation and why those variables are there at the moment. Okay. Remember that you must always regress the returns on the security, on the returns on the market. Beta reflects the slope of the regression relationship. It is equal to the formula for the beta now. Beta formula, okay? So sometimes you may be asked to determine the beta, that BJ here. This is the beta, okay? You may be asked by the examiner, okay, to determine the value or the formula or to determine the beta from the information given. So just have to be comfortable with the formula there. Okay, so beta is determined by the covariance of Rj, Rm divided by the variance of the market. Okay, so where covariance is the covariance between the return on security J and the return on market portfolio. It is equal to Rjt minus Rj. The summation of minus Rjt minus Rj multiplied by Rmt minus Rm, all divided by n minus 1. And you also have to acquaint yourself with these formulas. That's the calculation of the beta. So we are given this information, ladies and gentlemen, so that we play around with the computation. Okay, so we have the year information, the return on the security Rj, then the return on market portfolio. And remember, the equation is given there. Okay, you just have to be comfortable with this formula, because it is going to assist us in our next computation, where we are saying that beta is equal to the covariance of Rj, Rm divided by the variance of the market's portfolio. So here now the computations have been done for us. We just have to appreciate, and this is the information for the returns of security J and the returns for the market. All right, and you just have to slot in the variables as indicated in our formula there for the beta. Okay, this is actually self-explanatory, and the computations have been given there, where you end up having a beta of 0.76. Just have to follow through the computations until you reach this value. Okay, just for 1 minute sake. Okay, let me just take you back a bit. Okay, I'm sure you can see the J we are talking about. This is the return. Okay, and this is the return on the market portfolio. This one was for the return on security J, and this one is the return for the market portfolio. And this is the same information that has been appended here. Okay, so just have to follow these steps throughout. Okay, just follow the steps throughout until you get to this summation. Okay, all right. Let's move on. And these are the formulas when you are dealing with a portfolio of assets. We are saying that expected return is equal to the weight multiplied by the return, and you get the summation of it. That's the expected return for the portfolio. The variance is given as follows, where we are saying weight x2 multiplied by variance plus weight y. Okay, weight y multiplied by variance plus 2 weight x weight y multiplied by sigma x y. All right. Okay, I think this formula is not actually visible. Okay, it's not clear, so let me just rewrite it here so that you won't struggle, okay. Formula for portfolio variance, okay, it should be, okay, the formula should be okay, PV, portfolio variance, is equal to W1, okay, that is the weight of the portfolio, weight of the first asset, okay, that's the weight of the first asset, all right, and we can simply just put a 2 here, okay, and the standard deviation we have to multiply with this variance, okay, that's the variance of this asset, the variance of the first asset, all right, and then we multiply by the weight of the second asset, okay, the weight of the second asset. So you can see that it is better to differentiate these assets with the x, okay, and I wasn't clearly seeing that this x, okay, and then the second asset we can call it y, sorry, okay, second asset can be called y, okay, this is the second asset, and then its variance again, variance of this asset, variance of y, okay, plus the 2, okay, the 2, then weight x, okay, and weight y. Okay, this sigma xy is simply the covariance of x and y. So you can also simply say covariance x, y, covariance x, y. Okay, so you need to determine, first calculate this covariance, okay, you need the covariance for you to come up with the portfolio variance, all right, and you just have to know how to calculate the covariance, and we discussed about the formula for the covariance just a few moments ago, okay, covariance, sorry, okay, we talk about the covariance, all right, let us just talk about it here, the covariance, okay, not a big deal, not a big deal. Okay, when we talk of covariance, we are simply referring to the degree to which returns of two securities, okay, the returns of two securities vary or change together, and covariance can either be negative or positive, can either be positive or negative. When it is positive, this means that the returns of the two securities move in the same direction, whereas when it is negative, it implies that the returns of the two securities move in opposite directions. So covariance is given by this formula, okay? Covariance of A and B, or Ri and Rij, is equal to probability of Ri minus expected return I, in bracket, multiplied by Rj 1 minus expected return Rj, plus probability 2, okay, second probability, and this is an issue of marrying like and like, okay, this is an issue of marrying like and like, as we discussed in the previous section, okay, above. All right, so we just have to use this formula when we want to calculate the covariance, where probabilities are involved, okay. So let us at least find an example where we can discuss more about this. Yes, the returns on securities 1 and 2 under 5 possible states of the economy are given below. So these are the states of nature or the state of the economy, and then the probability and the returns for security 1 and security 2. Expected returns on securities 1 and 2 as follows. All right. So the usual formula for calculating the expected return, you just say the probability marrying it to the relevant security plus the probability marrying it to the relevant security, that is 15 here, and then 30 marrying it to 18, then 20 marrying it to 22, 10 marrying it to 27. We have finished with the expected return for security 1, that's 16%. We do the same for security 2, where we're saying probability and 5%, that's it. Then 30%, 12%, here it is, 30% and 19%, 20%, 20% and 15%, 20%, 15, then 10, this is 0.1 and 12. We're done. That's the expected returns for these securities. Now let's move on to the computation of covariance between the returns on the securities. Remember the covariance formula, okay? The expected returns, these ones are the figures we have just calculated, okay? These are the figures we have just calculated, expected returns. Okay, we then have to determine the covariance now, but we need to determine the other figures which are involved in this covariance formula, and let us see what are they. Okay, just a minute. Okay, so we simply just copy and paste from the question, then the probabilities we just copy and paste as they are. You can see here they're just the same. Okay, then the return on security 1 we just also have to copy and paste, as you can see here. This is the same information for security 1, but here now this is where it becomes interesting. But if you are listening very carefully, you can see that it is written deviation of the return on security 1, deviation of the return on security 1 from its mean, and we are told that the mean for security 1 is computed here, 16%, for security 2 14%. So deviation from the mean is 16%, so that's minus 16%, we get 26%, minus 16%, we get minus 1, minus 16%, we get minus 2, 20 minus 16%, we get 6, 27 minus 16%, we get 11. We are done. Because why do we need this deviation? Because in the formula for the covariance, there is need for that deviation to be established. You can see here. This is the deviation, RI minus RI. Expected return. Okay. And we have to multiply by the deviation of Rj minus expected return of Rj. So you can see that that's X and Y multiplied by Y. Okay. Because Ri minus expected return of Ri, that's, you can call that bracket X, and then the other bracket Rj minus expected return of Rj, then that's Y. So you can see that it's a matter of x multiplied by y. Okay. All right. Let's move. So for return 2, just have to, copy and paste again. Then the deviation. Remember, here the mean was 14%. So 5 minus 14, you get a 9, a negative 9. Then 12% minus 14%, you get a negative 2. 90% minus 14%, you get a positive 5. 50% minus 14%, you get a positive 1. 12% minus 14%, you get a negative 2. Then after that, then you have to multiply to get the product of the deviations and the probability. So that's the probabilities, just have to multiply across the deviations. So set 0.3 here, 0.3 multiply this. Let's start from the first line. 0.01 multiplied by the deviation, which is 26%, multiplied by 9%. Let us try and see. 0.1 multiplied by minus 26 multiplied by 9, and we get 23.4. Okay, that's 23.4. Just have to ignore the percentages and just take the integers. Okay, so that's 23.4, 6, this and that. So you then have to add them up and get the sum. That's the 26. Okay, so the covariance between the returns on the two securities is 26. But what is important is for you to know that when it is positive, it means they move in the same direction. When it is negative, it means they are going separate direction. This one is going this way and the other one is going that way. It's written here. A positive covariance means that the returns of the two securities move in the same direction, whereas the negative covariance implies that the returns of the two securities move in the opposite direction. Okay, and there is also an issue of correlation. Covariance and correlation are conceptually analogous in the sense both of them reflect the degree of co-movement between two variables. Mathematically, they are related as follows. Correlation Ri, Rj, or Pij is equal to covariance. Okay, got covariance Rj, Ri divided by standard deviation of Ri, or standard deviation of R, and multiplied by standard deviation of Rj. Okay, where Ri, Rj, correlation of Ri, Rj is equal to Pij, is the correlation coefficient between the return on securities I and J. That the correlation coefficient is simply covariance divided by the product of standard deviations. The correlation coefficient can vary between -1 to 0 and +1 and 0, +1, 0. So that's -1 and +1. That's the distance or apart, okay, or that's the range between the range of the correlation coefficient, -1 and 1. All right. That being said, we can safely okay, I just want to explain a few things about the capital asset pricing model. Okay, capital asset pricing model, the CAPM, is based on the following assumptions. Investors are risk averse, and we talked about this in the initial parts of this lecture, that the main concept surrounding risk and return, the main concept surrounding risk and return is that the main assumption surrounding risk and return is that investors are risk averse. Security returns are normally distributed. They follow a normal distribution. Okay, they follow a normal distribution. You know that one, the Z scores. It is the utility function of investors is quadratic. Okay, investors have homogeneous expectations. They have identical subjective estimates of the means, variance, and covariance among returns. Investors can borrow and lend freely at riskless rate of interest. Okay, something came up in my mind. Okay. Before we delve much into the CAPM issues, there is an issue about the covariance I want to highlight. In the exam, you might be given information with probabilities, but you might also be given information without probabilities. So the covariance of the two assets might also follow this formula. Okay, just have to be careful there. Covariance, let's say between assets X and Y. Okay, the covariance of X and Y would be okay, covariance X and Y would be the summation of X, all right, XI, okay, or XI minus the mean of X then Y I minus the mean of Y. Okay, X bar or Y bar simply means mean of X or mean of Y respectively. Okay, and then N. But this one now is the covariance of X and Y for the whole population of X's and Y. But you may also be given a symbol, okay, just a small symbol, and you just have to, if it is a symbol, you just write the same things, but you just have to deduct a 1 if it is a symbol. But if it is a population, then you have to ignore the -1. You have to ignore this. If it is a population, for a population, covariance for a population. All right, yeah, it only came into my mind because I only gave you the formula where probabilities are involved, but sometimes you may be asked a question where there are no probabilities and you just have to use the number of items, the n. Okay, then let us continue with where we left, so investors can borrow and lend freely at a riskless rate of interest. What is this riskless rate of interest? Okay, here we simply refer to, okay, so we are simply referring to the risk-free rate, okay? Risk-free rate of return. Okay, so that's the rate where the investors would be expecting to this is the rate where the investors feel that their investments are not going to be subjected to any risk. Okay, and it represents the return. Okay, it represents the return on an investment which would be absolutely risk free. Okay, that is over a specified period of time. The investors in that situation would be expecting nothing to come across their investment. Okay, and a risk-free rate could be the rate expected on treasury bonds. Okay, treasury bonds. Okay, or government debt. Government debt. All right. It is a general view that, or general belief that government debt or treasury bonds, they are risk-free. Okay, they are risk-free. So if you invest in government um, debt or treasury bonds, the assumption is that there is no government that is going to go broke, okay, or to liquidate. Governments are said to be always in existence forever. So if you invest in them, then you are not going to face some default risk in the repayment of your loan if you loan government money. All right. So this uh, risk-free rate, okay, or interest is is said to be recoverable. Okay, it is recoverable. It is going to, you're going to get back your money, right? But the question that is going to be asked is that how far competitive is this rate? Usually, it is going to be very small because of its riskless nature. Okay, it is going to be um, a bit low. Okay, it is going to be very low because it is a low risk rate. Okay, there is low risk, so everyone is likely to be, to flock into that particular investment. So this is why treasury bonds fetch very minimal returns because of their riskless nature. All right, so how do you calculate this risk-free rate? Usually, risk-free rate is usually obtained by calculating or deducting um, the current inflation rate from the treasury yield, okay, or the yield on treasury bonds. So usually this rate is that is, let's say the bond is being traded at 2.5. Okay, that's the rate of the current treasury bond. Okay, then we have to deduct some inflation. Okay, they say the inflation is going at 0.4. Okay, 0.4%. So it means that the risk-free rate would be about 2.1%. So it's about the yield on treasury bond and the inflation rate. Then we get this is the risk-free rate. If you invest at 2.1%, you're not going to face any problem. Okay, that's the assumption on the capital asset pricing model, that investors can borrow and lend freely at riskless rate of interest. So that's the riskless rate of interest which investors could be willing to borrow or lend. The market is perfect. That is, there are no taxes, there are no transaction costs, securities are completely divisible. The market is very, very competitive. So, for example, at this particular rate, it means that the government is willing to borrow, and investors are also available. That is the perfect market situation, where there are many buyers and many suppliers. Okay, buyers are there, suppliers are there, everything is moving as expected. The quantity of risk securities in the market is given. All right, so all the information is available, and the information asymmetry is very, 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 very low. All the information you need, you can obtain. So these are just the assumptions of the capital asset pricing model. But the major of these assumptions, the major one, okay, the most prominent of these assumptions is that investors are risk averse, which means when they invest in a more risk investment, they expect more return or higher returns. So high risk, high return is an old adage that represents the CAPM formula. As you can see there is expected return is equal to risk-free, which we have discussed, the riskless rate of interest, plus market risk minus the risk-free rate multiplied by the beta. The CAPM equation is a linear relationship between the required return and risk, and is also called the security market line. If beta is 1, the security is just as risky as the overall stock market. If beta is greater than 1, the security is riskier than the average stock market. If beta is less than 1, the security is less risky than the average stock market. So most stocks have betas in the range of 0.5 to 1.5. Betas are often calculated by regression on historical data. RI is equal to AI plus PI RM. So you can using stock market data, you can do some regression and obtain the beta values. Okay, that's the theory you need to just read around. Okay, where we talk about the types of risk, there is what is called diversifiable and non-diversifiable risk. Diversifiable risk is that portion of an asset's risk that is attributable to firm-specific random causes such as strikes, lawsuits, regulatory action, or loss of key customer. This can be eliminated through diversification, also called unsystematic risk. So diversifiable risk is risk which is related to issues like random causes such as strikes, lawsuits, regulatory actions, or the loss of a key customer. If you want to prepare yourself from this risk, you need to diversify. Okay, so diversifiable risk is also called unsystematic risk. You can prevent, it is actually firm specific. It is firm specific. Okay, lawsuits against your firm, loss of key employees or key customers, they are firm specific. So you may reduce those risks by diversify. Other than having one type of business, you can as well invest in other businesses so that when a key customer goes in your shop in a particular town, you might survive on the earnings of other shops which are in different towns. That's unsystematic. But when we talk of non-diversifiable risk or systematic risk, we are saying these are the risks which affect the entire economy. The entire economy. For example, political events, the change of government, or the change of the currency, etc. Those ones, you can't eliminate them by diversifying, because even if you buy shares in another company, they are going to face the same fate of a change in government or a change in currency. Because an investor can easily create a portfolio of assets that will eliminate virtually all diversifiable risk. The only relevant risk is non-diversifiable risk. So this is why the finance subject gets interesting, because you will see that the finance guys, though, are concentrating on those difficult portions. So we are not worried much about the risks which can be diversified, but we are worried about those risks which are non-diversifiable. An investor or firm, therefore, must be concerned solely with non-diversifiable risks. So, the measurement of non-diversifiable risk is thus of primary importance in selecting assets with the most desired risk-return characteristics. For efficient portfolio, the relationship between risk and return is depicted by a straight line. The equation for this line, called the capital market line, is expected return is equal to risk-free plus lambda sigma j, where expected return is expected return on portfolio, j, RF the risk-free rate, lambda is the slope of the capital market line, and sigma j is the standard deviation of portfolio j. The slope of this CML can be obtained as follows. Lambda is equal to expected return on the market minus risk-free rate divided by sigma, where lambda, the slope of the CML, may be regarded as the price of risk in the market. So the security market line again is there, and you need to differentiate between the capital market line and the security market line. But for the purpose of this presentation, let me just take you through the issues to do with the gearing issues. Okay, these ones are just straightforward, these formulas. This is the Sharpe's ratio, and Trinos ratio. The RAM is for the market return, risk-free rate over the standard deviation. The other one is over the beta. Okay, and Sharpe ratio. Okay, that's portfolio return. Okay, that's portfolio return. This one, the Sharpe. This one is portfolio. Okay, portfolio return PR minus RF over sigma, and this one is over beta. Yes, this is portfolio return. All right, it's fine. Okay. So you need also this one now is still portfolio return, not market return. Okay, fine. So right, yeah. With those, we just want to conclude our lecture with a few notes on project-specific discount rates. We have already seen that the CAPM is a method of calculating the return required on an investment based on an assessment of risk. When the business risk of an investment project differs from the business risk of the investing company, the return required on the investment project is different from the average return required on the investing company's existing business operations. This means that it is not appropriate to use the investing company's existing cost of capital as the discount rate for the investment. Instead, the CAPM can be used to calculate a project-specific discount rate that reflects the business risk of the investment project. So, in other words, they're saying that since we have discussed about diversification, okay, there might come a time when you feel you need to change or to invest in another area. Okay, let's say you are a vegetable vendor, you're a vegetable vendor, and you now want to venture electricity, to become an electricity vendor now. Okay, we can't use, let's say your cost of capital here is, or let's say your return, expected return is 10%. So when you want to venture into electricity, the electricity market, we can't actually use your 10% expected return to evaluate the feasibility of the electricity business. But we can look at other companies who are in electricity vendoring. So if they have, those are the companies which we may call proxies for the purpose of evaluating the electricity vendoring business. Okay, so we look for a company that is in electricity vendoring for us to determine or to compute a project-specific discount rate. I'm sure we are together there. So proxy companies and proxy bidders. The first step in using the CAPM to calculate a project-specific discount rate is to look for companies whose business operations are similar to the proposed investment project. So we talked about this one. For example, if a food processing company was looking at an investment in chrome mining, it would need to locate some chrome mining companies. Companies undertaking similar business operations to a proposed investment are known as proxy companies Okay, that's what we did. Now, there is need for us to differentiate between business and financial risk. If you were to look at an equity beta of several chrome mining companies, however, it is very unlikely that they would have the same value. The reason for this is that equity betas reflect not only the business risk of a company's operations, but also the risk of a company. Remember, in our CAPM equation, RE, okay, or ER is equal to RF plus beta RM minus RF. This is the equation which we have seen so far for the CAPM. But this beta here can be a BE or a BA. A BE beta equity is for a company which is both which is financed both by equity or debt. But this one is wholly financed by equity, wholly equity. Okay? So, beta equity reflects not only business risk of a company's operations, but also financial risk of a company. The systematic risk represented by equity betas therefore include both business and financial risk. Financial risk is usually because of the fact that debt has to be repaid at a particular point in time in the future. So, debt financing has got some financial risk attached to it. Okay? You'll see as we proceed. So, the asset beta, which reflects business risk alone, is linked to the equity beta by the asset beta formula as follows. The asset beta, which reflects business risk only, I said BA is for wholly equity financed finance business, wholly equity finance business, no debt. So the only risk we see from such a company is business risk. We're only going to see business risk alone and not financial risk. So there is a formula for us to appreciate. Beta asset is equal to VE over VE plus VD1 minus T multiplied by beta equity plus VD1 minus T over VE plus VD1 minus T multiplied by BD. Beta debt. This is beta equity. This is beta equity. Beta equity. And this one is beta debt or debt beta. Debt beta and equity beta or beta equity, and then asset beta. Okay, so beta asset, all right, is a beta for a wholly equity finance company, whereas beta equity is for a company which is financed by both debt and equity. All right, we need this equation Very important. All right. But one more thing to note is that usually beta debt is considered zero, is usually given a value of 0. So in most computations, the beta debt portion is silent, okay, is considered to have a 0. Now, to proceed with calculating a project-specific discount rate, we need to remove the effect of the financial risk or gearing from each of the proxy equity betas in order to find their asset betas, which are betas that reflect business risk alone. If a company has no gearing and hence no financial risk, its equity beta and its asset beta have the same value. If a company has no gearing or is not financed by debt, therefore the BA would be equal to BE. All right, let's move on. Now, and getting the betas, the equity betas. The asset beta formula is a bit unwieldy, and so it is usual to make the simplifying assumption that the beta of debt BD is 0. This is a relatively minor simplification because the debt beta is usually very small compared to the equity beta, so it is usually insignificant. In addition, and I'm sure this is because of the tax deductibility of debt. In addition, the market value of the company's debt is usually very small in comparison to market value of its equity, and the tax efficiency of debt reduces the weighting of the debt beta even further. Assuming the debt beta is 0, the asset beta formula becomes this way. We have removed the debt beta. So if the equity beta, the gearing, and the tax rate of the proxy company are known, this amended asset beta formula can be used to calculate the proxy company's asset beta. Since this calculation removes the effect of the financial risk of the gearing of the proxy company from the proxy beta, it is usually called ungearing the equity beta. Similarly, the amended asset beta formula is called the ungearing formula. Okay, averaging asset betas. After the equity betas of several proxy companies have been ungeared, it is usually found that the resulting asset betas have slightly different values. This is not surprising since it is unlikely that two proxy companies will have identical systematic business risk. Even two chrome mining companies will not be mining the same chrome seam or mining the same kind of chrome or selling chrome into the same market. If one of the calculated asset betas is very different from the others, however, it would be regarded with suspicion and excluded from further consideration. So let us just go straight to an example. Okay. So, like I said, there is the issue is about this beta. Okay, in the CAPM formula, we need to know which beta to use before we appraise a project. And these are the steps. When you are given a question in the exam, you just have to know these steps to calculate a project specific, okay, a discount rate. You have to locate a suitable proxy company, that a company that is in the business already where you want to invest. Okay, the company which is already in the particular industry, just have to use that one to determine a project-specific discount rate. Determine the equity betas of the proxy companies, their gearing and tax rates, and get the proxy equity betas to obtain asset beta. Calculate an average asset beta, re-gear the asset beta, use the CAPM to calculate the project-specific cost of equity. All right, so that's what we are going to do in the next example. A limited is identical in all operating and risk characteristics to G limited, except that A limited is an all equity financed company, and G is financed by equity and debt in the ratio 75-25 at market valuation. The beta factor of A limited is 0.9. G limited's debt capital is virtually risk-free and corporation tax is levied at the rate of 33%. The expected return on the market is 12% and the risk-free rate is 6%. So calculate the equity beta of G limited and the cost of equity for the entity. So we know already that beta asset is equal to VE over VE plus VT1 minus T multiplied by VE. Okay, and we are told here the beta factor of A limited is 0.9. A limited is identical in operating and risk characteristics to G limited, except that A limited is all equity finance. Okay, and G is financed by equity and debt in the ratio. The beta factor of A limited is 0.9. G limited's debt capital is virtually risk-free and corporation tax is levied at the rate of 33%. The expected return on the market is 12% and the risk-free rate is 6%. Calculate the equity beta of G limited and the cost of equity for the entity. So we are told that A is an all equity finance company. So which means that its beta, the beta factor of A limited is 0.9. So this is actually a beta asset. So already let us load the figures in the formula. So 0.9, the beta asset is what? 0.9. Okay, 0.9 value of equity VE, that's 75, because we are given this ratio. G limited debt capital, and G is financed by equity and debt in the ratio 75-25. 75-25. So the equity is 75 over 75 plus the VD, value of debt, is 25. 1 minus T is the tax rate. Tax rate is 33%. 1 minus 33%, that's 57, 0.67. Applied by BE. Because we are simply following these steps, we have to identify an all equity proxy company with a beta factor observable for listed entities only. It is an ungeared beta factor. So we can see that A is actually a good proxy, okay, and its beta asset is the one which we are using, okay. So we are done with this then gear the prox and its ungeared beta using, we are now re-gear, we are now gearing, okay, we're now gearing the the prox company's ungeared beta. So BE is the geared beta which we want to find in this particular formula. So if we solve for BE, we must get something. So let us do 0.09. 0.9 is equal to, let us solve here. That's 75 over, in brackets, 75 plus 25 multiplied by 0.067. 0.67. Okay, we get 0.817438692 BE. So solving for BE, we can see that BE is equal to 1.101. So that's the equity beta we are having here. All right, sorry, that's the equity beta. So we are done with this one. Then we have to substitute the beta into the CAPM formula, and we know the CAPM formula, KE is equal to RF plus BE RM minus RF. So the risk-free rate is given here as 6%. So 6% plus the beta, which we have already calculated, which we have just calculated, 1.101. Is a 1 day 1.101. Okay. The market risk, the return on the market is 12% minus the risk-free rate of 6%, and I'm sure we get 1.101 multiplied by 6. That's 6 point chart plus 6. That's 12.06. 12.61%. I'm sure that's it, and this is the same value here. We are done. Okay. We also need to look around the arbitrage pricing theory, which is another step above the CAPM. Okay, it assumes that the capital markets are perfectly competitive and that investors always prefer more wealth to less wealth with certainty. So the arbitrage pricing model or theory assumes that the return on the asset is linearly related to a set of risk factors as follows. That is, RI is equal to expected return plus BI1, L1, then BI2, L2, and so forth, right? And normally, this theory assumes that there are so many things which affect the success of an investment. Okay, and this is why you see that these factors are so many. All right, it doesn't look at only few aspects like this, the risk-free rate and the market return. There are so many variables which affect the performance of assets in an economy. So that's basically what the arbitrage pricing theory stipulates. All right, and we need to look around those and read the notes to complete everything, so that when we attempt the exercises, we are not going to be found on the wrong side. But basically, I think we have done justice to the theory of risk and return, and we just need to do the polish up with the exercises, so that after the exercises we'll then deliberate in more detail over these issues. Okay, and I hope you have enjoyed everything so far, and we are going to be there to assist one another where we found some glitches and we need some further explanations. We can always engage and continue in our studies and our lecture series. Hope I'll find you well next time. May you please enjoy the rest of the week with your risk and return topic. May the good Lord bless you. Thank you.